We want to be paying less for a business where we can leverage and play seller psychology into the negotiation.
Dealmakers, what's up?
My vision is to completely and utterly disrupt the market for buying and selling small businesses all over the world.
Hey guys, Carl Allen back with another one of your massive burning questions. What's the number one burning question that a brand new rookie into deal making is going to ask? What was that? How do you value a business? Great. So let's talk about that today on this video. So what is valuation? Now, there's two ways to really think about valuation when you're buying a small business. Okay, number one, there's a financial valuation, and we'll get to that in a minute. And number two, and this is what most deal makers fail to think about, is there's a psychological valuation. Think about it for a second. You know, sometimes like over the Christmas season, when there's like really crazy runs on particular products. So I don't know if you guys remember like the Buzz Lightyear toy. When Buzz Lightyear came out way back when Toy Story was like a big thing, some of those products at Christmas were going for like crazy amounts of money. I remember just a few years ago, I was buying, I wanted the brand new Xbox Series 1X, the latest version of the Xbox. And you couldn't get them anywhere. We were still dealing with supply chain issues through COVID. And I paid like double the amount of price on eBay for one of these things. You know, I'm a big fan of Rolex watches. And, you know, I paid sometimes double the retail price of a Rolex because you just can't get them in a store. You've got to buy them secondhand. So sometimes our psychology changes our perceived valuation of something. Now, I talked about Rolexes, Xboxes, and Buzz Lightyear toys where we'll overpay for a business over and above financial valuation. Obviously, as deal makers, we want to do it in the opposite way. We want to be paying less for a business where we can leverage and play seller psychology into the negotiation. So when we look at the financial valuation of a business, most businesses in the world are valued at a multiple of profit. Now that profit that we use is called Ebitda, which stands for earnings before interest, tax, depreciation, and amortization. Depreciation is when you buy like a truck or a piece of equipment, and then you can write that off through your income statement. And amortization is the depreciation of like an intangible asset like goodwill or R&D patents, IP, all those different things. So Ebitda is a really kind of good measure to kind of the cash flow the business is generating from its operation. One of the terms that you might have seen bandied around a lot, especially if you go into the broker site, is the term SDE. Now, SDE stands for Seller's Discretionary Earnings, and it's basically the Ebitda of the business plus the owner's compensation. So SDE equals Ebitda, and then you're adding back the owner's comp. If you're looking to buy that business and the owner's running the business and stepping away, you're either going to have to pay yourself to it and run it, or you're going to be hiring a general manager to come in and run that business for you. So really, Ebitda is the number that we're using for a multiple. There are lots of other more complicated ways of valuing businesses. You can use discounted cash flow analysis. You can use balance sheet methods. There's a whole bunch of other different things. But 99% of the deals that you're going to look at, they're going to be valued on a multiple of Ebitda. So when a broker or somebody says to you, hey, I want a 3 times multiple or I want a 4 times multiple, then really it's the multiple of Ebitda that they're quoting. So there's two things that really drive the size of that multiple. Right. One is the actual size of the profit. So the bigger the profit in a business, the bigger the multiple that it trades for. That's like, for example, why Apple, I'm a Wall Street guy, I still write the stock ticker codes down when I'm looking at businesses. So Apple trades at 24 times Ebitda. It's a massive multi-trillion-dollar business with all of these redundancies and systems. One of the finest companies in the world. The average small business in 2022 sold for 2.7x times its EBITDA. So we're looking at deals really south of $1 million of EBITDA generally. So if you have a business doing 5 million top line, which is really the top of the buy box, and it's doing a 20% profit margin, which is quite healthy, then you're going to be buying a business with around $1 million of EBITDA. We tend to kind of stay below that level. And then what also drives valuation as well is the quality of the business. So in any industry, there's a range of multiples that apply. So some industries like online businesses, SaaS companies, healthcare companies, some very, very high-end professional services companies like a cybersecurity consulting business, they're going to trade at higher multiple ranges. So they might trade in the 4 to kind of 7x range, but then a kind of a sector that's not as hot, like engineering or manufacturing or say home services, still an amazing sector to do deals in, by the way. It's one of my favorites. But those businesses in those markets kind of trade in the kind of 1, 2, 4, maybe 5x range. So what's really interesting is, as a business owner, when you're selling your business, you can't control the range of multiples in your industry. What you can control, however, is where you land in that range. And that takes us to the vertical chart, vertical line on our chart here. So it all depends on the quality of the business. So if you've got a business that's growing, the revenues are growing, you've got high margins, there's a lot of intellectual property, a lot of barriers to entry, the competitors coming in to your market share, you've got unbelievable systems and processes, you've got fantastic kind of human capital, fantastic social capital inside of your business, that's going to drive you higher up that range in your industry. But if you're below average on all these different things, so most of the businesses that you look at will be low growth, low margin, they'll be not commodity businesses, but there'll be nothing really special about them. They'll have low IP, no barriers to entry, kind of average systems and processes, that you're going to be down in the 1 to 2x range. So if we look at the multiples from 2022, if the average multiple is under 3x, that means that on average, businesses are trading below the center of that range, which is really, really important. So that is the financial way that businesses are valued. We basically take the EBITDA, we adjust it for add backs, and we recast it with what it's going to cost you to run that business, etc. And then you apply a multiple based on first the range of the industry that you're targeting, plus then the quality of the business. So that's a very kind of scientific methodology. Now, what if I told you that that was only 20% of the equation? The 80% of the equation is seller psychology. So let me explain what I mean by that. Imagine for a minute that you have two completely identical businesses. So we have business A and business B. Get out of the way so you can see this. So these businesses are absolutely identical. They sell the same product or service. They're in the same town or city. They've got the same employees, the same systems, the same processes. They have the same product or service. They have the same customers. They have the same revenue, the same Ebitda. They have the same balance sheet. They have the same makeup of assets. Everything is completely identical. There's only one thing that's different between business A and business B, and it's the owner. So imagine business A. Let's say we've got a 35-year-old entrepreneur. He or she is pretty happy in the role, likes the business. They're prepared to sell the business, but at a premium valuation. Now, every business is for sale. It's just a question of how much you're prepared to pay for that business. It's like the Xbox or the Beanie Baby or the Buzz Lightyear toy or the Rolex, whatever it is. Everything's for sale, just a question of the price, okay? So this business owner, very, very happy, he might want to sell at the top of that range. Doesn't matter how good or bad his metrics are. He's like, well, I don't really care whether I'm low growth, low margin, low IP, low barriers to entry, not great people, systems and processes. I don't really care about that. I own my business and I'm prepared to sell it to you as the buyer if you pay me at the top of that range. So he might want a 4 to 5x multiple, but more importantly, he's going to want the vast majority of that money when he sells the business to you at the closing table. So that could be 80% or more of the cash at the closing table. So let's say this guy's doing $250,000 a year in recasted Ebitda, and he's looking for a 4 times multiple, which would be above the average. He's going to want $1 million to sell that business to you. He might want $800,000 or more at the closing table. Now, that's where the SBA 7A loan program goes in. So you go and raise $100,000 from an equity investor. You could get $800,000 off the SBA, 50% loan to value. So you can actually pay this guy $900,000 at the closing table. So even with somebody that doesn't really want to sell unless it's a premium valuation, you can still do that deal using SBA 7A loan financing. However, where we're really focusing our energy and our efforts as a Dealmaker Wealth Society across my massive student base is the opposite of that. So we want a business owner that's distressed. It's a distressed seller of a good business. What do I mean by that? It's somebody that's highly motivated to come out of the business for retirement, sickness, boredom, burnout, frustration, whatever it is. Divorce is another example, but their business is cash flowing. It's a really good business. So that business owner, because he's highly motivated to come out of the business and sell it to you so he can go off and do whatever he wants to do next, retire or move on to something else or fix a broken marriage or deal with whatever issues they've got, he or she is prepared to sell at the lower side of that rate. So he might sell the say a 2x multiple, and he's prepared to take the vast majority of the money deferred into the future. That's called seller financing. So let's say it's the same business doing $250,000 of recasted Ebitda. So he might say, look, Carl, I'll sell you this business for $500,000. I'll take 10% down. So I'll take $50,000 at closing, allows me to pay my lawyer and maybe go off and have a little bit of fun. But then I'll take $450,000 as a seller financing note. Okay. What's great about that is that $50,000 closing payment can actually come directly from within the business. You can use the surplus cash that's in the business's bank account to make that closing payment. So business A, if you want to buy that business, you got to pull the master. That might take you 4 months because you've got to go through the SBA. They're going to do lots of detailed financial diligence. They're going to create lots of legal contracts. You've got to go through the process, right? And that's fine. But absolute either best-in-class businesses or businesses you really like, where you've got unmotivated sellers that want to exit, you can go and do a business A deal using the SBA 7A loan program. But business B is where you can get deals done much, much faster. So with business B, you're not going to any external financiers. You don't have to go and pitch investors or family offices or angels or even, use your HELOC or any other kind of retirement savings you've got like your 401k or your Roth, your IRA or whatever it is. You can go and basically take the $50,000 surplus cash out of the business's bank account. Surplus cash is cash that the business doesn't need to operate. It's just there. It's just extra. The owner's not taking it out. They can take that out at the closing table. It's more tax efficient for them rather than taking it as income. And then you're just paying them that $450,000 over a period of time. Now, if you're really good, you could do that over a 10-year term. That's called an annuity deal. So you'd pay $45,000 per year for 10 years to create that $450,000 seller note. This business is cranking $250,000 of cash flow. You could actually pay more money in business B than you can in business A. It's the same business. He's completely motivated to get out. He's not. You can actually offer to pay him more money because you can stretch that money over a longer period of time. But what I'm here to tell you is most of the time, you don't have to do that. He's so motivated to come out of the deal. He'll take the surplus cash that's in the business. Yes, you'll be inheriting some of the liabilities in that business as well, So that valuation gets adjusted accordingly. We'll get into that on another video. But I just wanted to kind of showcase for you why valuation is purely not just a mathematical formula. That comes into it. That's probably 20% of the calculation. What's the 80% is understanding seller psychology. I'll do a video for you later where I walk through what are the 5 killer questions you should always ask a seller in your very, very first meeting. And the first thing that should come out of your mouth once you've built rapport, you've built relationships is this: why are you selling? Ask it 4, 5, 6 times. Ask it from different angles and different perspectives. You really need to understand what's the motivation for sale. Once we know that, then we can almost put them on this scale. Yeah, this is important. This is important. But understanding seller psychology, seller mindset, absolutely mission critical. And what drives me crazy is nobody does this stuff. I'm the only deal maker, the only coach that does this stuff that talks about seller psychology. And it's the number one critical factor that you truly need to understand as a deal maker. So that was my take on valuation. I hope that you enjoyed that and you learned something from it. Do Uncle Carl a favor, hit the like button for this video, share it as well if you would be so kind, and definitely subscribe to this channel. That means every time I put out another video, you're going to get notified within a nanosecond. Then you can continue to learn and master these deal making concepts. So have a great rest of the day. I will stop the video right now and I will see you soon. Until then, bye for now.